Today, folks, this market is nothing short of astonishing. So much so that YouTubers that don't even talk about finance are now talking about finance, and my tax advantaged accounts just crossed $300,000, which is quite insane. And many of you are aware of my holdings. VDY, my monthly paying Canadian dividend ETF, is up about 13%, not including the dividends, of course. On the US side of my TFSA, we got Google, VOO. Google starting to bear fruit for the first time after really lagging the market conditions to now catching up and consistently offering gains day after day, while my S&P position's up 17%. My RRSP, where I've started to accumulate some XEQTs, up 4.5 percentage points, nothing crazy. But VOO, my goodness, ever since I sold SCHD, not looking back, up 17 damn percent. Are you kidding me? $10,000 gain there. Beautiful. When we look at the major holdings with my some of my corporate account investments, I mean, Google, Meta here, again, double-digit returns in such a short period of time, continuing to help excel beyond market average returns. I'm shocked to see Google up 20 or Facebook up 25%, and I wouldn't be surprised if Google starts getting to that range here very soon. And I'll talk about these on an individual basis in a moment. Of course, my biggest S&P position overall is almost worth 100,000 US now, and this one's up 46 damn percent. So much so that in this account specifically, I have a hard time wanting to sell any of these now because I don't want to pay the gains on it. Not that the taxes are that material for what I'd be pulling out, but my God, when you start watching your account do these big steps, you really just don't want to touch anything, and you just kind of want to leave it idle and let it kind of work its magic here, considering, if we look at the major indices that I hold between VDY, VOO, and XEQT, over the last year, the returns have been double digits, which again is peculiarly insane. It's awesome, especially considering how much we bought during the tariff war that really excelled our accounts just within the recent months. I mean, the returns coming out of this, again, are insane, really represented in my RRSP. That 17% gain literally was me just buying VOO somewhere around, I think, the end of April there. And year to date, again, VDY still outpacing the rest of the markets, but I wouldn't be surprised if the S&P starts catching up here. But when it comes to these valuations, we are sitting in what is defined based on past performance and expensive market. All past metrics are leading toward what should represent lower returns in the future. At least that's what I'm hearing across a lot of YouTube channels. And I want to kind of discuss it. As the Canadian market's set at just under a 20 PE right now. And this, I don't know what website this is called, PEratio.com, and it does a pretty good job at just taking the historical metrics, kind of projecting them forward and giving us an understanding of like the trailing versus forward returns, with expected forward returns to only be about 4.8% annualized over the next 10 years in the Canadian markets. Kind of crazy. We got the US, and I just want to point out that the historical averages for Canada is a PE of 13 to 17. Again, we're at 19. The US, we're sitting at about 26, 27 PE. Historical over the last 5 years has been a 19 to a 24. And if we scroll down in the same kind of breath, take a look at what the forward expectations are here. 6.84% on the trailing versus forward returns. So there's not high expectations of excelling from where we were, right? And I just want to say, is this accurate or is it not? Because coming from where April was, where the market looked cheap, to now all of a sudden in a few months the market looking incredibly expensive, we need to break this down a bit more in depthly. So if you're on a path to financial independence, if you damn well one day want to retire early, join me on that journey by simply hitting that subscribe button, folks. And thanks to everybody that went to kylelivingston.com. I appreciate the one-on-one conversations. It's a very fulfilling part of my job, actually talking with you guys on an individual basis and getting to see how my content has impacted you and just having personal conversations about finance in general. You can go support me as well at kylelivingston.com, link in the description below. But if you haven't seen Hank Green, massive YouTuber, I mean, 2.45 million subscribers, and he recently made a video called I'm Changing How I Manage My Money Because of AI. And he was a gentleman that never has ever talked about finance, mostly just science, weird stuff across the board, but nonetheless mentioned that he owns a lot of S&P 500, and out of fear of the concentration that's been going on, he wanted diversity, so he started buying emerging market funds, not to a huge extent, but literally just doing what a lot of people advise with something like XEQT or global market ETFs that just kind of give you a little less weighting in the US, but gives you all the other markets where the valuations aren't perhaps nearly as stretched. But if we take a look, one of the biggest concerns was that the top 10 holdings now make up like 30% of the fund. And I was kind of shocked to see this as well. Like, it's incredible to see the divergence that the top 10 holdings have had. And I'm kind of confused on if this is being driven from a lot of passive investing, because I think 60% of all investing today is now passive, whereas you went back to like 1980, it was barely like 5%, which just means most people become like you or me, where we let the markets decide what the valuations are. And, these are market cap weighted ETFs, so they just get a position based on the size of their market cap. But the reality of this is every time I put money into this, regardless about valuations, they just get allocated to these stocks. So the upper holdings tend to continue to get concentration as me and you continue to buy. And this is what could be known as basically an ETF bubble. And it's cause of some concern because it removes market efficiency. Whereas if there's a lot of individual holders, people might say, hey, I don't trust the valuations, and it could lead to better values. And I'm not sure if we're in an inefficient market, but we are definitely in a bull market that is getting frothy here, right? I mean, it's crazy to think Nvidia, Microsoft, and Apple, just Nvidia and Microsoft alone make up 14% weighting, right? Like, it's incredible, even the top 5 holdings and the control they have over where this market is going. And I always have mixed reactions from my own personal valuations on these stocks, but we can see, there's people like Unusual Whale and a lot of people pointing out that basically the 10 biggest companies are now pulling away from the bottom half of the market and basically representing the vast majority of the returns, which we can see, right? Look at the year-to-date returns. Healthcare has been lagging. Financials, yeah, there's some mixed results there, but man, when you look at technology services between Meta, Microsoft, Palantir, Oracle, Nvidia, AVG, like there's just so many companies that are tech related that have just absolutely slaughtered. And honestly, we're in a frothy market too when margin comes back. Like, this is the first time where margins hit like over $1 trillion, and margin really follows what I feel like the rhetoric to the market is. That there's a lot of concern, market's downtrending, margin tends to get evaporated by up to 20%. And then when the market gets incredibly bullish, we tend to exaggerate that, right? As people get more and more confident and comfortable leveraging into the upcycle that we're currently sitting in. Comparably though, when I'm thinking about valuations, and I want to look at the Canadian market, because I think this is something that we really have to understand and pay attention to, is what is the future potential? Because you can't use past metrics to look in the future, especially considering how different the markets are today with technology. In fact, we've been in the greatest bull run in human history over 15 years just because of the technological advancements. And the Canadian markets have excelled and trade at higher values, but when you look at the size of non-energy minerals and the impact this has on the overall market, and I've said this, for as long as gold, precious metals, commodities trade at record highs, guys, for the foreseeable year, 2 years, the valuations on these companies are going to start to expand dramatically. I mean, you go back a year ago, gold was trading at $2,600 an ounce, and we're at 34, let alone silver, copper, some of these assets. So in considering Canada is such a commodity rich country, and it's one of the biggest sectors in our economy, and you look at the 60% gains these things are having, and they continue to hit all-time highs. And I told you, it's such an easy trade, one that I should have just been more involved with, but I've been so focused on Google that, I missed the boat here, but it's still going. Like, for as long as these precious metals stay up every single quarter, every little production increase is going to yield massive margin expansion, and again, continue to pull forward valuation. So you can start understanding how when things change in the market environment and earnings potential can go up dramatically and margin potential can go up dramatically, it deserves a higher forward value. So when I'm looking at, these charts from whatever, world PE ratio is, they're literally taking all the historical averages to dictate future returns, which you can't say we're in a historically normal market when gold and a lot of things are changing into this new realm, like the expansion of AI and all this stuff. And I think it's frothy. I know it's frothy. And I know it's frothy because people are blindly throwing money at anything that has massive return. I do have some mild regrets because I was looking at Ethereum at around 3,000 and I was going to buy it and it just kept running. So I said, forget it. And now it's at like 4,500 and I probably would have sold it now anyways. But these are buy and hold assets. They have no underlying current use cases that people are materially using driving the value up. And the same could be said for a lot of stocks. I mean, there's so many stocks trading at wicked high values, pulling forward 5 or 10 years of value, and there's just no way I could see them actually justifying it anytime soon. And eventually we'll hit a speed bump. I've mentioned this time and time again. We go through speed bumps in the market. people get a little fearful. Valuations correct as markets kind of take a little cooling period. And I would be surprised if sometime down the road we see another 20% correction like we did in April. They happen fairly often now in this market, like really often, considering typically the average correction takes like 10 years to unfold recessionary events. Yet we've seen like how many now since the last 5 years: the pandemic, the inflationary cycle, the interest rate cycle, the tariff war, the geopolitical events, and the bombing in like Iran's nuclear facilities. Like, it is wild, the absolute volatile events we've seen. And yet the market has actually survived these, just proving these dips have been nothing more than major buying opportunities. So I'm not really looking again at the markets that have rallied excessively. I don't like pulling forward massive valuations because, again, it requires perfection into longer periods into the future that we know isn't going to be perfect. So I turn to stocks that kind of meet all the same factors of AI, of growth. They have underlying crazy growth, but they're mismatched in their price to earnings because of obviously macro events. And Google is the best example of this, which I think we're past the point of people thinking search is going away. We just got to get through this court case of monopolistic fines where they're probably going to be forced to sever off a part of their business, which I'm arguing has potential to be worth more separately than under the current 21, 22 PE this company has. But incredible to see us finally getting a rate of return off of this. And I've said this, that Google should be the largest company in the world. Obviously, if I zoom my head out here, you guys know comparable net income to the other mega earners out there, like the biggest earning companies, and Nvidia hasn't even come close to these yet. It'll take another few quarters, I think, for Nvidia to like surpass this, but it's trading at those growth values. But right now, Google makes more net income, more earnings per my dollar than any mega cap company, or any company for that matter, in the world. And it blows my mind that it can grow earnings at a 20 to 30% clip, yet still trade at these fundamental values. We have seen Perplexity try and come in and offer to purchase Google Chrome for $34.5 billion, which is incredible because they're saying that's worth more than the actual value of Perplexity itself. So there's no shortage of people out there willing to buy any of Google's assets, and I think this is more of a joke offer. I can't imagine Google's entertaining this at this current moment until we know what they're going to get away with when it comes to the actual court remedies for that case. But when we look at Meta on the other spectrum, and the reason I really focus on the advertiser players is because people have yet to recognize that these should be trading at 30 to 40 times multiples, just like Microsoft and Apple. These are the new modern day brick and mortar businesses. We all live our entire lives now through these social media platforms, and they have become permeated through the entire globe in a manner where half the world's population is basically using one of Meta's apps, and they're not going to be disrupted by anything anytime soon. With the onslaught of TikTok, anytime somebody makes something new, its market penetration is weak. I mean, even Snap is kind of struggling in this market environment. Like, we know what the dominating platforms are. Instagram is sticking, YouTube is sticking. Every kid wants to be a YouTuber. We know what these business models are worth today. They are how we conduct our social lives and our businesses, and the entire world is still upgrading to these platforms. And I just don't get how people misprice these just based on that alone. So I still think Meta's probably favorably valued here at a 28 PE. I'm obviously not buying it here. Is buying it back down to the 540 range. Nothing crazy. Got some good prices. My fiance owns a huge chunk of this. And yeah, these are going to be the driving factors to our portfolio as I focus on the few and cost average of the many as usual. Meta hits a record 78, and it's just really the AI and ad growth that's driving momentum in this really bullish market. We're still seeing a lot of ad expansion, which is great for Google and Meta. I still think being heavily mispriced. And again, I just want to point out the earnings that I just mentioned, but are insane, right? I mean, when it comes to Google and Meta, there are no better business models for growth right now, in my opinion, in the S&P top 10. There's just nothing comparable at this scale, at these valuations, right? So I figure buying these brings down my overall portfolio value. I get some good valuations from the Canadian market, and I'm hoping if we hit some speed bumps that might remove a bit of the volatility, but individual stocks and advertisers, players especially, when we go into economic uncertainty, people become more uncertain about people's willingness to spend on advertising. But I think these companies have proven they can survive some pretty wild moments in the market. So we'll see how things unfold. But I will pass the question off to you at this point. I'd love to know what you think about the markets, what you think about forward valuations. I'm not getting too caught up in them personally because I just don't know, and I try not to predict the future as much as possible. But I recognize that I want to be a bit more cautious, a bit more careful how I leapfrog around this market environment. environment just to not get caught up in crazy high flying stocks, because I promise you, just as quickly as they go up, eventually they could just come down as quick. But I would love to know what you're doing here in that comment section below.